Every month, thousands of Indian professionals in the US write massive rent checks to a landlord, wondering if they should just buy a house instead of waiting years in the green card backlog. There is a persistent myth that you need permanent residency to buy real estate here. That is completely false. There is absolutely zero US law preventing an H-1B visa holder from buying, owning, or selling property. But while it is perfectly legal, the mechanics of getting a mortgage are different for temporary workers compared to US citizens. You are looking at a dual risk scenario. You need to build long-term equity, but tying up your cash in a house severely restricts your short-term liquidity. For immigrants, a sudden job loss doesn't just cut off your income, it triggers a 60-day deportation clock. Trying to sell an illiquid asset like a house in under 2 months to avoid deportation can lead to a significant financial loss. Moving from renter to owner requires a strategic evaluation of exactly when to enter the market. Matching your purchase to your immigration timeline protects your equity and prevents a forced sale during a visa crisis. Before a bank even looks at your visa status, you have to clear the standard underwriting baseline. Lenders want to see a minimum credit score of 680 and exactly 2 years of continuous U.S. employment history. If you just moved to the U.S., you have to rent for at least 24 months. It delays building equity, but it forces you to acclimate financially and build that required W-2 paper trail. This chart shows down payments on a $400,000 home. 3% requires $12,000, but triggers private mortgage insurance, adding hundreds to your monthly burn rate. Stretching to a 20% down payment requires $80,000, draining liquid cash right before taking on massive new debt. For an H-1B holder, dropping to zero liquidity is dangerous. You need to retain a 6-month cash emergency fund after closing to survive sudden layoffs or visa renewal delays. To hit the 20% mark while keeping their emergency fund intact, many immigrants pull in cash via international wire transfers from family back home. Lenders scrutinize foreign transfers heavily. You will have to provide certified gift letters and exact proof of the source of those funds. Otherwise, your closing will be delayed or denied entirely. An optimized down payment preserves the liquid financial runway needed to navigate the structural volatility of an H-1B visa. Once your finances are in order, underwriters focus on your immigration paperwork. The highest hurdle is the remaining validity on your I-797 visa stamp. Banks assess their risk based on your legal right to stay in the country. Most lenders require you to have a minimum of 1 full year of remaining validity on your visa to approve a mortgage. If your H-1B stamp is nearing its expiration date, you need to spend the time and capital to secure your renewal before you initiate the home buying process. With your documents cleared, you have to choose your loan architecture. For most buyers, this comes down to an FHA loan versus a conventional loan. This matrix compares your options. The FHA loan grants approval for credit scores around 580 with 3.5% down, but includes permanent, uncancelable mortgage insurance. The conventional option demands a 740 score and 20% down, unlocking competitive rates and avoiding permanent insurance fees. With a conventional loan, the mortgage insurance automatically drops off once you reach 20% equity in the home, lowering your monthly holding costs. While an FHA loan gets you into a house quickly, the conventional loan is the architecture used by H-1B holders to optimize long-term equity and minimize monthly risk. To figure out if you are personally ready, we use the timing formula. This evaluates your market readiness based on where you are in your immigration journey. This flowchart breaks down 3 specific scenarios. First is the near-term migrator. If you expect to receive your green card in under 2 years, the math points to wait. Delaying purchase bypasses H-1B scrutiny, granting citizen underwriting. Next, the new arrival. Under 2 years in the U.S. means waiting, lacking W-2 history. Finally, the settled optimizer. Green card 5 years away. With a down payment and 6-month reserve ready, you can buy now. For immigrant professionals, the right time to buy real estate is dictated by your proximity to permanent residency, not just the size of your bank account. If the formula shows you are mathematically and legally cleared to enter the housing market, here is your execution plan. First, optimize your credit score to 740 or higher. Lock down your 20% down payment while strictly isolating that 6-month emergency cash buffer so it isn't spent on closing costs. Second, audit your I-797 stamp to ensure you have at least 1 year of remaining validity and secure certified gift letters for any international funds. Third, do not accept the first mortgage offer you get. Failing to compare multiple lenders can cost tens of thousands of dollars over 30 years, even on a fraction of a percent interest difference. Fourth, mandate a strict home inspection contingency on every offer you make. You have to protect your liquid capital from hidden repair traps. Buying a home on an H-1B visa carries heavy, calculated risks, but by rigorously timing your market entry, you can stop funding a landlord's mortgage and finally build your own American equity.